Be Wealthy and Smart, episode 1338.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about a wealth survey that shows very surprising attitudes that Americans have toward money. Now, this survey was done by Northwestern Mutual and surveyed multiple generations. The first thing that was interesting is the results said just over half, or 54% of U.S. adults, expect the U.S. will enter a recession this year. While still a majority, it's a substantial drop from the two-thirds who predicted a recession last year, which was 67%. And it seemed that the higher expectations that the economy will enter into a recession came from Generation Z, then the Millennial generation, then Generation X, and last the baby boomers. 62% of Gen Z predict a recession, 59% of millennials, 53% of Gen X, and 48% of boomers. Also, Americans' feeling of personal financial insecurity are on the rise. One-third, or 33% of adults, say they do not feel financially secure, which is a jump from 27% who said that last year. And it's the highest level of financial insecurity recorded in this study's history. And they've been doing their study since 2009. Inflation is the clear reason why people are feeling financially insecure. Despite inflation rates coming down substantially since their peak in 2022, more than 54% of U.S. adults expect inflation to increase this year, and only 9% say their household income is outpacing it. By far, inflation is considered the greatest obstacle to financial security, coming in well ahead of factors such as lack of savings and debt. Why do people feel so concerned? Well, the main reason is government dysfunction. Americans are particularly worried about the impact that decisions or indecision by government officials could have on their financial well-being this year. When asked to rank the concerns that could impact their finances the most in 2024, 57% said inflation, but government dysfunction was 34%, and the U.S. presidential election was 33%, coming in ahead of other worries such as a potential recession, 24%, interest rates, 24%, market volatility, 15%, and geopolitical conflicts, 14%. With the way current market and economic conditions are, 42% of U.S. adults feel 2024 is a year to prioritize, quote, playing defense, unquote, with their savings and investments, which is managing risk to protect their assets, versus 29% who feel it's a year to be, quote, playing offense, end quote, which would be more of capitalizing on opportunities to grow your assets, and 29% are not sure. For those who are playing defense, they are mostly focused on cutting costs, 56%, and building savings, 51%. Younger generations score higher on adding a side hustle, 46% for Gen Z and 43% for millennials. And about 1 in 6 millennials, or 16%, said they would get a financial advisor, while 15% said they would buy life insurance or increase life insurance coverage. Among high net worth individuals, people with more than $1 million in investable assets, higher numbers reported moving into safe, high-yielding instruments like money market funds. 40% said that. And for those who favor playing offense, it's mostly focused on investing more in the stock market, 42%. Particularly for Gen Z, 52%, and the high net worth individuals, 50%. About half as many Americans indicated interest in investing more in real estate, 21%. High-yield bonds, 21%, alternative assets like hedge funds and private equity, 19%, and speculative investments like cryptocurrencies, 17%. Just 9% expect to invest more in gold or silver. So I just want to pause there for a minute and say, it's often a good idea to go opposite of what the crowd is doing. The crowd may be following a path that may not show that they've taken the time to financially educate themselves, especially with current market conditions, with geopolitical conditions, etc. Adding a small amount of gold or silver or cryptocurrencies to your portfolio could be extremely important right now. That's because what's going on with the BRICS nations proposing an alternative currency to the United States dollar could at some point mean that we have a weaker dollar. And should that happen, you'll want to have your money in some alternatives. So back to the survey, there are some differences from the time that the survey was done during COVID. Because during that time, Americans said they considered themselves disciplined financial planners, 65%, and now, today in 2024, only 45% of Americans say they consider themselves disciplined financial planners. And despite higher inflation and feeling financially insecure, many Americans don't expect to pull back their spending on discretionary things like restaurants, vacations, and entertainment in 2024. The research finds 59% of U.S. adults say they'll either spend the same amount or more on these purchases year over year, while just under 4 in 10, or 37%, say they'll spend less. Among generations, Gen Z is the most likely to say they'll increase non-essential spending, and Gen X is the most likely to say they'll be tightening their belts. When talking about retirement, the amount of money that Americans think they need in order to retire is surging to an all-time high, rising much faster than the rate of inflation and swelling more than 50% since the onset of the pandemic. U.S. adults now believe they will need $1.46 million to retire comfortably, a 15% increase over the $1.27 million reported last year, and far outpacing today's inflation rate, which is currently between 2 and 3%. Over a 5-year span, people's number for retirement has jumped a whopping 53% from a $951,000 target that Americans had in 2020. So that trend since 2020, when it was $951,000, has increased over 50%. In 2021, people felt they needed a little bit over $1 million to be able to retire comfortably. In 2022, it was $1.25 million to retire comfortably. In 2023, it was slightly higher at $1.27 million to retire comfortably, but in 2024, it's jumped to $1.46 million to retire comfortably. By generation, both Gen Z and millennials expect to need more than $1.6 million to retire comfortably, and high net worth individuals, those with more than $1 million in investable assets, say they'll need nearly $4 million to retire comfortably. Meanwhile, the average amount that U.S. adults have saved for retirement has dropped from $89,300 in 2023 to $88,400 today, but it's more than $10,000 off its 5-year peak of $98,800 in 2021. So the gap between what people say they need for retirement and what they have saved for retirement is roughly $1.37 million. And even the high net worth individuals who say they need $4 million to retire comfortably only have $172,100 saved for retirement, which means they have a gap of $3.76 million. Interestingly, only 3 in 10 Americans have a plan to minimize the taxes they pay on their retirement savings. Among the top 10 strategies include making withdrawals strategically from traditional and Roth accounts to remain in a lower tax bracket, 32% said that, using a mix of traditional and Roth retirement accounts, 30%, making strategic charitable donations, 24%, using a health savings account, HSA, or other tax-advantaged healthcare account, 23%, using products like permanent life insurance or annuities for the tax benefits, 22%, making Roth conversions prior to taking required minimum distributions or Social Security, 19%, using qualified charitable distributions from an IRA, 17%, making contributions to other tax-advantaged accounts like a 529 plan, 14%, using the basis paid into the cash value of permanent life insurance to remain in a lower tax bracket, 13%, taking advantage of a qualified longevity annuity contract to set aside funds for later in retirement, 13%. So while you're getting the picture of how Americans are feeling about their finances, the important thing to remember is that you're in control. You're in the driver's seat. It's up to you what you do with your money. That will determine how it all turns out and how it grows over your lifetime. Obviously, starting to save earlier for retirement is better. You'll not only have to save less if you start sooner, but also you have longer to compound your money and grow it into a larger nest egg for you. If you're getting a late start, then you want to look at investing more and investing in things that can compound at higher rates for you. And my podcast on the McT Formula, the wealth building formula McT, and in my Wealth Heiress book, talk about how to make up for lost time if you are behind the ball saving for retirement. So I encourage you to pick up a copy of the Wealth Heiress book or check out my podcast on the wealth building formula McT. You can find all of my podcasts on my website at lindapjones.com/podcasts, and I'll leave a link in the description below for my Wealth Heiress book. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.